In a surprise move on the 4th of May, the Reserve Bank of India announced a 0.4% increase in the repo rate and a 0.5% hike in the cash reserve ratio. This was done to curb inflation, which has spiked in recent times. In fact, April consumer price inflation printed about 7.79%, which is the highest since 2014 and well above RBI's upper tolerance limit of 6%. Now, inflation has been rising due to higher food and commodity prices, driven by the strong growth recovery, as well as the more recent Russia-Ukraine conflict as well. And in fact, Indian bond markets reacted quite swiftly to this move from the RBI, with the 10-year government security benchmark yield jumping by about 30 basis points to 7.4%. Going ahead, market participants expect the RBI to hike rates by another at least 0.8 to 1%, taking the repo rate to its pre-pandemic level of about 5.25 to 5.5% over the next few quarters. Clearly the interest rate cycle has shifted from being easy to tightening, where interest rates are expected to move up. So in the current scenario, how should debt investors react to this shift in the cycle? Now, before addressing that question directly, a few important things to keep in mind while looking at debt investments. First up is that debt plays an important role in a portfolio. It acts as a cushion in periods when equity markets are falling sharply. For instance, in early 2020, when equity markets corrected sharply at the onset of the pandemic, debt investments were fairly steady. It also generates regular income and provides attractive investment opportunities from time to time. Secondly, bond prices and interest rates are like the opposite side of a seesaw, right? When one side goes up, the other goes down. Similarly, when interest rates go up, bond prices go down and vice versa. And the extent to which bond prices fluctuate in response to interest rate movements depends on the duration of the bond. Higher the duration, greater the fluctuation in bond prices. Further, as the maturity of a bond increases, one would expect to generate a higher yield due to the higher risk in holding longer tenor bonds. And the difference between yields for various bond tenors is the term spread. Now, this is just like fixed deposits, right, where interest rates tend to be higher for longer tenors. For example, the one-year treasury bill issued by the Government of India currently yields around 5.85%, and the 10-year government bond yields about 7.35%. Accordingly, the term spread between the one-year treasury bill and the 10-year GSEC is about 1.5%. Historically, this spread has averaged about 1.25%, indicating that the current spread is quite attractive. Now, if the RBI continues to hike rates further, it is likely that yields on short-term bonds would move up more than those on longer tenor bonds, which have already risen in anticipation of further rate hikes. So, basis this, where should investors make their debt investments? For investors in debt mutual funds with a horizon of 3 years and above, around 40 to 50% of the corpus can be invested in funds with a portfolio duration of about 1 to 3 years. And this typically includes banking and PSU funds and corporate bond funds, where the impact of interest rate increases on return would be limited due to the low duration. Around 10 to 20% can be parked in liquid or ultra short-term funds, which typically carry a duration of less than 1 year. And yields on these funds would start rising, now given that interest rates are starting to move up. And given the attractive spreads, one could invest about 25 to 35% in medium to long-term debt funds or dynamic bond funds, particularly those holding government securities. And finally, one can also consider passive or target maturity funds, which invest in government securities, say with a maturity of about 5 to 7 years and hold them till maturity. These securities are trading at attractive yields and expense ratios are lower than actively managed funds. And for investors in fixed deposits or individual bonds, one can stagger these investments as interest rates might go up further. Now, to summarize, the recent spike in volatility in equity and bond markets has been quite unnerving, right? But remember that markets are cyclical by nature, and periods of strong performance would tend to be followed by periods of under or low performance. Now, as an investor, one needs to focus on their goals, stick to their asset allocation plans, and avoid making decisions driven by short-term trends.